Welcome back to this lecture series titled The State of the United States Economy and Society. This is part 12. The subject of this lecture is death by debt strangulation. Throughout most of history, commerce has depended on the use of credit, particularly when large quantities of goods are involved. Kings, feudal lords, and governments have borrowed to engage in wars of territorial conquest or to defend territories already held. The stability of our economy today is dependent on the continuous access to affordable credit and direct loans by business, government, and individuals. The question is, are we approaching death by debt strangulation? A few comments on the role of money, credit, and debt in human history will be useful. The Crusades turned the Mediterranean into a vast trading area dependent on the use of gold and silver coinage and credit, bringing about the end of feudalism and its self-contained economies. As peasant farmers were charged money, rents, and taxes instead of a large portion of crops harvested, land also became a commodity to be bought, sold, and mortgaged. Debt became a constant feature of expanding commercial and civic relationships. For centuries, the banking families of the Mediterranean states provided the credit to fuel economic expansion and wars over territory and natural resources. The next great leap forward in the world's global economic structure was the establishment of the Bank of Amsterdam as a deposit bank, its receipt money circulating throughout Europe and beyond. The bank held the coinage of its depositors as full backing for the paper receipts issued. For a time, this model of full reserve deposit banking stimulated a remarkable expansion of commerce between merchants in different countries. Today's global economy functions mainly on the use of digital monetary transfers. Central bank notes are issued independent of any reserves of gold or silver coins or bullion. The paper currency we hold or the balances we own in banks have a constantly changing purchasing power. They are, in a sense, promises to pay nothing in particular. By declaring central bank notes and their digital equivalent as legal tender, government is able to raise needed revenue via taxation, from fees charged for the private use of public lands, and other fees in exchange for competition limiting licenses. Whether for business-to-business exchanges or business-to-consumer commerce, risk must be properly assessed and priced by credit issuers, or things do go quite wrong. Credit card debt is thought to be the number one reason individuals cannot put money aside as savings. Only a small portion of our population possesses sufficient financial assets to do without credit to make major purchases, although the use of credit cards in lieu of cash is a common practice even for those who pay off the balance each month. More than half of credit card holders do so. The Federal Reserve Bank of New York reports that as of the fourth quarter of 2025, credit card debt had climbed to $1.28 trillion. LendingTree reported in January of 2026 that the average unpaid balance is around $7,900. At the same time, 49% of cardholders pay off their balance each month, while 61% carry balances for at least a year. In 2026, approximately 10.7% to 11.1% of active credit card accounts at large banks are making only the minimum payment. However, broader consumer surveys suggest a much higher figure for general card holders, with roughly 22% reporting they only pay the minimum balance. Despite the high share of minimum payment users, serious delinquency rates, 90+ days past due, are expected to remain relatively flat at approximately 2.57% through 2026. Lenders are primarily tightening for lower income or higher risk borrowers to mitigate potential losses. Key ways they are doing this include higher credit score requirements. A significant share of banks, about 24% overall and 32% of large banks, have raised the minimum credit score required for approval. Approximately 22% of banks are reducing the maximum credit lines offered to new and sometimes existing customers. For most U.S. households, the highest level of debt incurred is mortgage debt taken on as a result of the purchase of a residential property. Only a small portion of households have savings sufficient to pay cash for a residential property. Those who do have sufficient cash or other financial assets tend to be longer-term property owners who have benefited by loan amortization and by appreciation of the value of land under a home. The amount of equity may be sufficient upon sale to permit a cash purchase of another property, particularly for empty nesters downsizing in anticipation of retirement. The Federal Reserve Bank of New York reported that at the end of the third quarter of 2024, that mortgage debt on 1 to 4 unit properties was $12.6 trillion. As property prices continue to increase, property buyers are incurring increasing levels of mortgage debt. The economics are straightforward. Historically, low mortgage interest rates enabled buyers to qualify for higher levels of borrowing, and this was capitalized by market forces into higher asking prices for property. In 2026, total single-family, that is 1 to 4 unit, mortgage origination volume is projected to reach between $2.2 trillion and $2.4 trillion. This represents an estimated 8% to 25% increase from 2025 levels, driven by stabilizing mortgage rates and a gradual rise in both home sales and refinance activity. Entering 2026, the mortgage market shows a significant widening in the delinquency rate spread between government-backed and conventional loans, largely driven by a sharp spike in FHA delinquencies at 11.52%. In 2026, the volume of home equity lines of credit is projected to experience significant growth, driven by a near record $34.5 trillion in total U.S. homeowner equity. When combined with projected closed-end second lien volumes estimated at $70 billion, the total home equity origination volume is forecasted to reach between $150 billion and $160 billion in 2026. CoreLogic reported that in the third quarter of 2024, there were around 1 million residential properties experiencing sufficient declines in market value, resulting in negative equity. The major cause has been natural disasters, such as the devastating wildfires in Hawaii and California and hurricanes in Florida. As of early 2026, roughly 1.1 to 1.2 million U.S. homeowners, about 2.1% to 2.2% of mortgaged properties, are in negative equity, marking a significant rise from previous years due to stalling home price appreciation. The surge, up nearly 60% from early 2025, largely impacts recent buyers with high loan-to-value ratios, that is 85 to 94%, and those with FHA, VA loans. As of early 2026, nearly 40% of U.S. homeowners, more than 33 million households, own their homes free and clear without a mortgage. This share has reached a record high of 40.3% in recent months, driven by aging populations paying off long-term loans and a surge in cash buyers. As of late 2025 and early this year, the median age of first-time home buyers in the U.S. has hit a record high of 40 years old, driven by high mortgage rates, low inventory, and significant affordability challenges. Data also indicates the median age of all home buyers, including repeat buyers, has risen steeply, with some reports citing it as high as 59. The median property price is now more than 5 times higher than median household income. Thus, the household income needed to make a purchase and qualify for mortgage financing keeps increasing, as well as the median age of the buyers. We'll now take a look at multifamily properties. Properties containing up to 4 units are considered residential and are eligible for conventional financing. Properties of 5 units and larger are considered income-producing investment properties. Total multifamily mortgage loan origination volume is forecasted to reach $399.2 billion in 2026, representing a 21% increase from the $330.6 billion expected in 2025. Activity is expected to be fueled by a wall of maturities, with approximately $196 billion in apartment loans scheduled to come due in 2026. Well, what about the construction environment? Well, a key factor affecting aggregate amount of credit in the economy is the number of new construction projects initiated. Credit is needed for land acquisition and site preparation costs, as well as actual construction loans. In 2025, the U.S. housing market saw a slight decline in new construction activity compared to the previous year, influenced by elevated interest rates and rising material costs. An estimated 1,497,800 housing units were completed, a 7.9% decrease from 2024. During the first quarter of 2025, the inventory of unsold homes on the market increased to 507,000 units, the highest level since October 2007. The supply of completed homes for sale was the highest since July 2009. 679,000 new single-family homes were sold during the year, a 1.1% dip from 2024. At the beginning of 2024, Travis Hicks, the CEO and co-chairman of Tri-Century Bank in DeSoto, Kansas, looked at the potential for construction lending and the demand side of the market. He wrote, "To the credit of the construction industry as compared to the years leading up to 2008, I believe many of the builders have been at the forefront of being conservative in this market. They have been careful, not wanting to get caught in the same situation holding inventory, so the numbers of developed lots and spec homes have been greatly reduced. This was evident as mortgage rates increased. It has been, and it is now, a lot harder to qualify the average consumer for an end loan." Housing construction costs in 2026 are expected to remain elevated, with most experts forecasting modest growth or a steady high baseline rather than a significant decline. While some material prices have stabilized, new pressures from tariffs, labor shortages, and persistent inflation are expected to drive overall project budgets upward. The National Association of Home Builders estimates that the latest wave of tariffs could add approximately $10,900 to the cost of a typical new home. Key impacted materials include steel, aluminum, and appliances. In 2026, the U.S. office construction sector is characterized by a historic slowdown in new builds, with the pipeline reaching its lowest level since the 1990s. Only 29 million square feet of office space is now under construction nationwide, a 43% year-over-year drop from early 2025. Contractors report significant impacts from tariffs and immigration enforcement, which have tightened the supply of both materials and skilled labor. The value of commercial real estate is generally determined by capitalizing the current and immediate future income stream generated by use of the property. Based on this, a lender must determine what level of financing is warranted. A commonly applied 90% debt service coverage ratio requirement means that the property itself must generate income sufficient to cover 90% of any mortgage loan debt. The remaining 10% might then come from other sources of revenue. In 2025, commercial and industrial loans experienced a complex landscape of tighter lending standards and fluctuating demand, often driven by supply chain risks and tariff uncertainties. While initial 2025 quarters showed weaker demand, by mid-2025, some sectors saw increased loan utilization and growth, particularly for smaller firms and in specialized areas like healthcare and professional services. Even though loan growth has been mixed, delinquent loans that are 90 days or more delinquent or in non-accrual status, were rising steadily in each of these categories. Examining the history of the nation's credit markets over the previous 5 decades, Wolf Reichter wrote in Business Insider in mid-2017 that a key indicator of the health of the economy, the volume of commercial and industrial loans, was not expanding, and this might be signaling a downturn on the horizon. He wrote, "Over the past 5 decades, each time commercial and industrial loan balances at U.S. banks shrank or stalled as companies cut back or as banks tightened their lending standards in reaction to the economy they found themselves in, a recession was either already in progress or would start soon. There has been no exception since the 1960s. Delinquency rates for mortgages backed by commercial properties decreased during the third quarter of 2025 compared to the prior quarter, but remained at over 4%. Next, we'll take a look at automobile debt. We are an automobile-dependent nation, and that will not change anytime soon. About 1 in 4 people pay for a new automobile with cash. However, 3 out of 4 finance the purchase. U.S. new vehicle sales in 2025 rose approximately 2.2% to 2.3%, totaling roughly 16.3 million units. This marked the market's best performance since 2019, driven by strong consumer demand in the first 9 months of the year before a noticeable slowdown in the fourth quarter. In 2025, the total amount of outstanding auto loan debt in the United States reached approximately $1.66 trillion. This figure marks a steady increase from previous years, with auto loans now accounting for roughly 8.9% of all American consumer debt. In 2025, auto loan delinquencies reached levels not seen since the Great Financial Crisis, driven by record vehicle prices and high interest rates. While overall financial health remained relatively consistent for some, the auto sector emerged as one of the riskiest consumer credit products. More and more people are struggling financially and having trouble making their car payments. During the first quarter of 2025, 1 in 5 new car buyers financed their purchase over 7 years. In 2025, automobile repossessions have surged to levels not seen since the Great Recession of 2009. While approximately 1.73 million vehicles were repossessed in 2024, data from late 2025 shows over 2.2 million vehicles had already been reclaimed by the third quarter, with projections suggesting the total would exceed 3 million by year end. While overall auto loan originations were slightly down in mid-2025, deep subprime auto debt saw an 8.7% jump, the largest increase of any credit score band. What about student loan debt? As of early 2026, total enrollment in U.S. colleges and universities is approximately 19.4 million students, reflecting a 1% increase over the previous year and a stabilization above pre-pandemic levels. While overall numbers are rising, enrollment patterns are shifting, with growth in community colleges and certificate programs alongside long-term concerns regarding a demographic enrollment cliff. Roughly 8.9 million students are white, 3.7 million Hispanic, 2.3 million Black, and 1.3 million Asian. As of early 2026, total U.S. student loan debt is approximately $1.77 trillion to $1.83 trillion, with federal debt comprising about $1.69 trillion of that total. Roughly 43 million Americans hold federal student loan debt, with an average federal debt balance of nearly $40,000. As of early 2026, over 3.5 million Americans aged 60 and older carry more than $125 billion in student loan debt. This demographic holds an average of $44,000 to $48,000 in student loans, with a significant portion resulting from Parent Plus loans or returning to school, causing some to face Social Security garnishment. As of January 2026, 3.62 million borrowers have defaulted since January 2025, with over $92 billion in defaulted debt. In early 2026, student loan defaults among older adults have reached critical levels following the full resumption of federal collections. Approximately 3.6 million new borrowers defaulted in 2025 alone, contributing to a total of 8.8 million federal borrowers in default by January 2026. As this graph illustrates, delinquencies in mid-2025 were 6 times higher than that which occurred in 2020. Over the past 20 years, 50% of Black and 40% of Hispanic student loan borrowers defaulted on their loan, compared with 29% of whites. For-profit colleges market to older adults and other non-traditional students, who often take on huge student loan debt, but often do not end up completing the program or obtaining a degree. The result is that they do not then earn an income sufficient to pay off the loans. The National Center for Education Statistics reported that more than half, 52.5%, of students at for-profit schools who started repaying federal student loans in 2003-2004 ended up defaulting at some point within the first 12 years of repayment. That's about triple the default rate for four-year private but non-profit schools, 17.6%, or four-year public schools, 17.4%, during the same period. Current statistics gathered by the nonprofit Complete College America indicated that fewer than 20% of community college students earn an associate's degree in 2 years. An action plan coming out of their November conference identified what participants believe is at stake. It said, "For too long, Americans have tolerated a two-tiered higher education system that perpetuates both privilege and inequity. A small number of elite institutions prepare a select few for lives of leadership and influence. Meanwhile, the vast majority of students, and most historically excluded students, are left to navigate a landscape of underfunded public colleges while incurring mounting debt. When higher education reinforces rather than decreases economic polarization, it undermines democracy." It continues, "Treating higher education as a private good rather than a public one undermines the very foundations of a participatory democracy. This approach has created a higher education system that not only is unjust, but also is helping fuel the country's current democracy crisis. There are corollary cost contributors that drive up the cost of a college education. Students take unnecessary non-degree related courses when they want a break from the academic rigor of their majors. Also, fully 60% of students transfer from one college to another and lose credits toward a graduation. Students frequently need a class that is either full or otherwise unavailable. That may leave them short of credit hours sufficient for scholarship and grant requirements. Therefore, students take classes they do not need simply to generate a credit hour load for financial aid purposes. Well, what are seniors to do? For many seniors in our society, in addition to benefits under our Social Security system, their one other important potential source of income is the equity they have in a residential property. Rising property values translate into more than $14.7 trillion in equity homeowners 62 and older could utilize to obtain additional income under the federal government's Home Equity Conversion Mortgage, or HECM, program. The Trump administration is tightening eligibility requirements to exclude non-permanent U.S. residents. Analysis in 2016 of the viability of the HECM program by the U.S. Department of Housing and Urban Development indicated the cost of administration made the program economically unviable as structured. Changes were announced taking effect in October of 2017 to lower the amount that could be borrowed to 58% of homeowners' equity. This and other program changes reduced the attractiveness of the HECM program, resulting in a lower number of applications during the program's 2017-2018 fiscal year that began in October and ended September 30th. The volume for fiscal year 2018-2019 fell even further to 26,500. The number of reverse mortgages approved in the United States decreased from 31,274 in 2019 to about 20,000 in 2024. The declining volume in 2023 and 2024 occurred primarily due to rising interest rates. Another important factor is the high upfront mortgage insurance premium associated with HECM loans. Government does in fact borrow. Well, what about government borrowing supposedly on our behalf? The national government has only 4 sources of revenue with which to pay for public goods and services. First is taxation. Second is charging fees for services and for allowing private exploitation of natural resources on public lands. Third is for the U.S. Treasury to pay for goods and services with non-interest-bearing notes that circulate as legal tender. And fourth is to issue government securities, that is, to borrow from the Federal Reserve System or domestic and foreign investors. Local and state governments have all of the same options as does the national government, except that states are prohibited from issuing paper currency. Local community organizations, however, can issue their own currency, and a growing number are doing so because of the shortage of national currency circulating within the community. The longer-term ramifications of continuously funding public expenditures by the issuance of bonds is of great concern to some, of almost no concern to others. Back in January of 2019, the new chairman of the Federal Reserve Board of Governors, Jerome Powell, expressed his concern at the Economic Club of Washington, D.C. From the Fed's standpoint, we're really looking at a business cycle length. That is our frame of reference. The long-run fiscal non-sustainability of the U.S. federal government isn't really something that plays into the medium term that is relevant for our policy decisions. However, it's a long-run issue that we definitely need to face and ultimately will have no choice but to face. At the time, the national debt was nearing $22 trillion. Economists were then and still are engaged in endless debate over the debt's threat to the U.S. economy. If the history of the nation's property markets continues to repeat, as I think the evidence supports, then 2026 will be the year when our property and financial markets will experience unmanageable stresses. On February 11, 2025, Jerome Powell offered the Federal Reserve's evaluation of what has been accomplished by its close management of the money supply. He stated, "The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% long-run goal, though it remains somewhat elevated." And what about the continued escalation of the national debt? The national debt of the United States has now surpassed $39 trillion, increasing by $6.4 billion each day. If the yield on government securities is 3%, the amount of revenue required to service the debt, that is, pay investors the interest, is $1.17 trillion annually, provided the debt does not increase and interest costs do not rise. Despite the discharging of thousands of federal employees and reduced funding to many departments and programs, there is no expectation that the national debt will stabilize, let alone begin to be paid down. Since the early 1980s, the federal government has borrowed and spent. Our elected representatives somehow expecting that a lowering of marginal tax rates on high-income individuals, on business profits, and on gains from the sale of financial and other assets would generate enough revenue to balance the federal budget and eventually pay down at least some of the national debt. This has not been the case. We shall soon learn whether the Trump administration's efforts to reduce the size of the federal government and other measures will have any positive effect. If the interest costs on government debt do continue to increase, the debate over tax increases will have to be renewed, perhaps after a change in parties with a majority in the U.S. Congress. It is likely that a political solution will be to impose new taxes on consumption rather than shifting the burden of taxation to unearned economic rents, as some of us argue is the necessary systemic reform. An analysis by the Congressional Budget Office forecasts that over the next decade, more than 14% of all revenue the government is projected to collect will be sucked up by interest payments. This will be higher than total Medicaid spending, will be equal to half of Social Security benefits paid out, and nearly equal to total defense spending. The United States is in need of a real program of comprehensive tax reform, once and for all, finally beginning to collect unearned economic rents from the many natural assets generating rent. Simultaneously, one part of the solution would be to adopt fully amortizing bonds as the means of refunding maturing debt. These bonds would pay to bondholders both interest and principal, so that when the bond matures, the principal is fully repaid. Of course, far more revenue would need to be raised than is now being raised. A bold alternative solution to the debt problem is to require the Federal Reserve to write off all federal debt on its books. After all, the money to invest in federal securities was created out of thin air. Then new money could be created by the Federal Reserve to gradually repay the principal on federal securities as they mature, retiring the debt. Once the above process has been completed, money creation could be returned to the U.S. Treasury, authorized to issue whatever amount is necessary to balance the federal budget. This money would be channeled to government departments to be spent into the economy. The ideas presented in the previous 2 slides come from a group of economists and others who have given serious thought to solving problems associated with our systems of monetary creation and the use of borrowing to pay for the cost of public goods and services. These individuals do not fully agree with one another's analysis or proposals, but they loosely comprise proponents of what is referred to as modern monetary theory. Stephanie Kelton is a professor of economics and public policy at Stony Brook University. She is a leading expert on modern monetary theory and a former chief economist on the U.S. Senate Budget Committee when chaired by Bernie Sanders. Professor Kelton advises policymakers and consults with investment banks and portfolio managers across the globe. She is a regular commentator on national radio and broadcast television. Her highly anticipated book, The Deficit Myth, became an instant New York Times bestseller. She writes, "Deficits do matter, but not the way we've been taught to believe. We've been told that China is our banker and that Social Security and Medicare are pushing us into crisis. We're told the U.S. could end up like Greece and that deficits will burden future generations. These are all myths. Deficits can be used for good or evil. They can enrich a small segment of the population, driving income and wealth inequality to new heights, while leaving millions behind. They can fund unjust wars that destabilize the world and cost millions their lives. Or they can be used to sustain life and build a more just economy that works for the many and not just a few." So we reach the end of this lecture on debt and whether or not it's going to strangle our economy. So what's next? Next, we'll take a look at another worrying segment of the economy, which is healthcare costs that we're incurring. We'll look at the state of the nation's healthcare system.